Nick Molnar and Anthony Eisen founded Afterpay more than 5 years ago. At the time, they didn't expect the company's market valuation to reach almost $40 billion.
I think we have a once-in-a-lifetime opportunity given the undercurrents of plates that are moving away from credit to debit, offline to online.
Much of the fintech success is thanks to millennials and Gen Z, who they're now targeting with new services like budgeting tools.
We don't think at all about turning Afterpay into a traditional banking service at all. We've got an advantage at the moment that we've got a very frequent and engaged customer base.
Afterpay's share price has surged by more than 1,400% since its low point in March, when it crashed to around $8. Some analysts were expecting the company to report a profit, but instead it lost $79 million.
I think it's very likely that in the future you'll see, as we scale, profitability emerge.
Afterpay's global sales are up 106% to $9.8 billion. On average, 23,000 new customers a day are being added to the platform. It now has more than 13 million active users around the world. Afterpay will raise $1.25 billion to increase ownership of its US business. It wants to keep growing in that lucrative market.
To have 15,000 retailers in North America and north of 8 million active customers.
The buy now pay later firm is also one of the best performing stocks for fund manager Michael Frazis. He's not worried the company is yet to make a profit or that its shares might be overvalued.
If you use that traditional lens, you're going to miss every single fast-growing software company, every single fast-growing fintech company, companies like Afterpay, companies like Netflix, companies like Tesla.
Afterpay is not the only buy now pay later stock experiencing explosive growth. In the 6 months to the end of last year, Zip made a net loss of $450 million, but sales grew 130% to $160 million. It now has 5.7 million customers worldwide, up from 1.8 million at the end of 2019. That's seen the company's share price rise more than 800% since March.
Zip is the quiet achiever, and if you compare us to our peer sets across transaction margin, revenue yield and revenue, we're definitely punching up there with the competition. And our view is that over time, investors will understand that.
The buy now, pay later sector is growing rapidly, but it's not without risk. Corporate watchdog ASIC recently found that 1 in 5 customers are missing payments. Consumer groups don't want the industry to self-regulate. They want to see these companies face the same rules as credit card providers. In the UK, that's already happening, but in Australia, ASIC has agreed not to slap regulations on the sector for now. Instead, there'll be an industry code of practice enforced by an independent committee with powers to name and shame lenders.
We believe we've set the bar very high, and higher in many ways than what the National Credit Code, for example, sets for traditional finance companies.
If you compare a Zip customer over here, about 1 in 100 is late in any given month. Contrast that with 1 in 6, which is what you see with some of the peers and credit cards.
Regulation risks aside, for now investors are happy. Andrew Higgs bought Afterpay shares in 2016 when they were just $1.61.
Over the past few years have invested over $4,000 and that has gone up by 4,000% to over $160,000.
If more shoppers ditch their credit cards in favour of buy now pay later apps, it's likely that more investors will jump in for a high risk, high reward stake.